Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by the IA's Dr. Jonathan Lipkin to talk about fund fees. Hello, Jonathan.
Hi.
So I thought I'd start by setting the scene, and that is over the last couple of years, it has been quite positive for investors in that fund fees have come down because of regulation, haven't they?
Yeah, we've seen falls in fee rates both in the active and passive market, and we see a very competitive market emerging. But we've also been clear that we think there's more to do in the context of disclosure, both of the fees and costs. And we also agree with the FCA that there needs to be a little bit more work done on the clarity of objectives and some of the reporting against the delivery of those objectives.
And I think that transparency is key because fund fees have come down, great news for the investor, but I think a lot of retail investors are still confused about what goes into that fee, what makes up that fee, where their money is going. And I think there is some move in the future coming through which will help with that, isn't there?
Yeah, we want there to be complete clarity and we want there to be consistency around two key points. Firstly, to be able to say, what am I charging you as the fund manager? And if the investor asks, what am I paying for the service that is the fund management, to be able to answer that very clearly, but also for there to be accountability of the costs that are incurred in investing the money. So to be clear, if you come as a retail investor and you invest in a fund, you're paying somebody to do the job that you could try to do yourself, but you've decided to entrust that money to a professional. And that professional will also incur transaction costs that you would have incurred had you tried to do it yourself. And it's important that you have accountability for both of those so that you can understand both the performance, the associated transaction costs of getting that performance, and what you have paid a professional, whether it's passive or active, to deliver you an investment return in a given market over a given time.
And I think that's really important, that breakdown, because different fund managers operate in different ways. Some will have higher transaction costs because that is the way they run their fund. They have a higher turnover, but that results in a higher performance. And others will be sort of the individuals that sit and hold. But without that information that you describe, it's difficult for investors to compare and contrast when making an investment decision. So without that information, they can't, make the best investment decision for themselves, can they?
Yeah, and we've put forward a framework now that will ensure that there's a consistent definition of portfolio turnover rate, so you can understand how fund manager behaviour may have varied from year to year, as well as understanding the transaction costs that are inherent in delivering the return. But you make the point very well. There is no inherent connection between transaction costs and investment performance. You need to be able to explain your investment performance and the associated transaction costs. And fees behave in a very different way. The higher the fee, the lower the investment return. Transaction costs do not behave in that way. There is no linear connection between the way that you invest and the return that is delivered. And I think the danger is that if you take those two pieces of information, the charges and the transaction costs, and put them together in a single number, it may be harder to understand. You'll certainly get the full economic experience of your money, but I think we need to have both of those pieces of information available. So just to be very clear, you should have total transparency, but we need to be mindful of how people might wish to use that information.
And what's the timeline for this? When can we expect to have this information in our hands?
Well, the European regulators are driving the timeline, and so MiFID II and the new PRIPS, the key information document that will be on the European regulatory front line, will be the beginning of 2018. There is new pension scheme reporting coming in the UK for defined contribution pension schemes. And if you put all of that together, you'll see a real paradigm shift over the next year. The IA code, which is intended to try and offer a consistent way through that, we hope will be completed in the summer of this year, but that is all subject to regulatory approval, particularly the outcome of the market study.
So watch this space.
Watch this space.
Jonathan, thank you very much.
Pleasure.
This is Emma Wall from Morningstar. Thank you for watching.